FOMO is running high among borrowers this week. Rates popped up 0.5% over the past 7 trading days, and it's created some serious fear of missing out from borrowers that are looking to purchase and refinance to lower rates. What's up, my real estate family? This is Norbert with another weekly rate and mortgage bond update for you. As I mentioned in last week's video, the Bureau of Labor Statistics jobs number really did a number on interest rates. Unfortunately, we have not been able to bounce back or correct this week. Week ending October the 11th, the average conventional 30-year fixed rate mortgage is sitting at 6 5/8 according to Mortgage News Daily Rate Index. Borrowers are paying approximately 3/4 in discount points to get that rate. Check out this 30-year fixed mortgage rate chart. You can see how rates have moved up 0.5 percentage point in just the last week, since last Monday. The FOMO is real for borrowers. So what happened this week? Well, we got a mixed bag of economic data. On Thursday, we got initial jobless claims. This measures the number of people filing for first-time unemployment benefits. The weekly claims were reported at 258,000, which was up 33,000 week over week. This is the highest number since August of 2023, and this did help mortgage rates. But also on Thursday, we got the Consumer Price Index report, or CPI, which measures inflation at the consumer level, and the core number came in hotter than what the markets were expecting. The year-over-year core rate came in at 3.3%, up from 3.2%. The Fed wants this number to be closer to 2%. This report fanned the flames of inflation fears and hurt mortgage bonds and pushed rates higher. Remember this, inflation is the biggest enemy of mortgage interest rates. The silver lining within the report was that the shelter component, it started to show signs of declining. Shelter represents about 46% of the overall weight of the CPI report. It's the largest component or overall number within the report. So as this comes down, so will the core inflation number. And in turn, mortgage rates will love it. So what is shelter? Well, it's a combination of rent, owner's equivalent rent, and lodging away from home. In other words, hotels and Airbnbs. The shelter component is 46% of the CPI number, and unfortunately, it has a major lag effect. The real-time or real-world number is actually closer to 3%, not the 4.9% being reported in the CPI report. Even the Federal Reserve acknowledged this lag effect in their meeting this past September. This shelter component is why many experts in the mortgage bond market feel like yields and rates will be heading lower over the next 12 months. As shelter catches up and comes down in the coming months, so will the overall inflation index. It'll come down. And most importantly for our industry, so will mortgage interest rates. And that will be awesome for our borrowers. Thank you for watching my rate update video. Make sure you watch and tune in for the next one. Until next time, let's get better, let's close more deals, and as Mick Jagger once said, give me shelter. Yeah,